So this is the midnight opening range. So the first thing you got to do is obviously find electronic trading hours, so non-regular trading hours. When you have it on electronic trading hours, what you're going to do is you're going to grab your vertical line here, and you're going to find midnight. So at midnight, we have this beginning reference point. So that's the beginning, and this is the end at 12:30. So you find 12:30 on a 1-minute chart right there. See that? So now all you have to do is find where is the opening candle at midnight right here. That candle, the low, and the high. There's 3 reference points there that are very, very crucial to me as a trader. So what 3 reference points are we looking at? Well, the first thing is the opening price at midnight. So that's the midnight opening price for Power 3. Power 3 is your daily range candlestick formation. This high is the midnight opening range high, and this is the low of the midnight opening range. Okay, so this information, once you have it, it provides a great deal of insight. In this drop here, from the high down to the low of the midnight opening range, I want to look for inefficiencies, order blocks, breakers, any PD array that I've taught in month 4 content of my paid membership and mentorship lectures, not all 81 of them. So if you notice this level right here, this single candle right there, that is your first reference point where the largest degree of displacement takes place. Notice that? Now, sure, we had a SIBI over here, but this one right here, much more pronounced, okay? Much more prominent. It really jumps off the chart. So by having this and measuring that inefficiency, we can now have a graded inefficiency that can be utilized. Oops, I just grabbed the wrong thing. Now, by having this information, we can go forward and use things like fibs that give you mathematically derived projections to where the daily highs and the daily lows will form. If you take the high here of that opening range at midnight, and we plot that like that, you see that? That will take us above these relative equal highs. How high can it go? How high can it go if it's going to sweep above this level here? And how low can it go when it starts to break lower should it do so? So here's negative 0.5, and then negative 1, and then we have the standard deviations that are projected lower down here. And now we have things that we can project going forward. We have some relative equal highs up here, so there's buy-side liquidity. And we can anticipate price running up into these levels here, and then we have standard deviation negative 1. Now, what is that measuring? Like, what is it that you're actually getting from that? You're getting the range low of the midnight opening range, that 30-minute interval between midnight and 12:30 Eastern time. If the market trades above it, then it can go 1/2 of one standard deviation or 1 standard deviation. So in other words, the actual range from the high to low, that range added to the high. That's all it is. So think like measured move. How hard and fast it goes to that degree of premium or discount is relative to an economic calendar event during London. Okay, so this is all helping you trade London session. That's what it's really based around. This is a very easy brass tacks approach to finding the 1 or 2 levels that generally, not all the time, but generally will deliver what you're going to be looking for a daily high or daily low. We have relative equal highs over here. You see that? So this one here is enough to do that. It trades up into it there. But then we have standard deviation 1 up here. So watch what happens later on in the day session. But for right now, I want you to look at what we have in London, okay? We have the standard deviation based on this inefficiency. If we take the range from low to high, that's this low here to that high, half a standard deviation, 1 standard deviation. If we use the inefficiency, we can do the same thing there, where we can take those levels and now we'll plot them from low of the inefficiency to the high. This inefficiency here, if we use that same idea of standard deviations from that, we can also get very, very precise elements to how the algorithm will rebook and redeliver to premium and discount, even inside of that midnight opening range. What do I mean by that? Well, this is first presented displacement. Okay, the displacement in and of itself is a PD array. Remember, we've already had a inefficiency offered here, here. Okay, so it's not that it's, you know, cell side imbalance in of itself. It's a very large one, and it's occurring inside of the midnight opening range. So it jumps off the chart. It's the first presented displacement. Notice that? So what happens when I add these same levels that are here, -1 and -0.5? What if I add that to this inefficiency on the upside? Well, you get these things like this. You get the 50 or half of it. That's this level here. Look what the bodies are doing. You see that? Look at all this. The close of that candle, the open of that candle, all this consolidation around there. Look at the bodies here, here, and it moves away from it. And then we have the -1 standard deviation here. What is it doing? It's creating this delivery of that high. Look at the bodies working around that and all the consolidation around here, and it runs away from it there. Now, what happens when we use this same idea and we add it to the projection below this inefficiency? You start from the high down to the low. -0.5. You can see how we're working this level here, and then finally at -1 standard deviation, we see it here, 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 and then rallies and starts working inside of that displacement in and of itself. So we can see there's boundaries that can be created with this. So the markets are absolutely not random. And you're going to try to argue with me and tell me that, you know, all the buyers came to the conclusion that this is a good time to buy, and sellers said, no, we're not interested in selling anything lower than that. So therefore the market stopped, turned on a dime and reversed, right? Wrong. Same thing here. The market is just going to randomly go down to that level here, stop, turn around, and go higher simply because sellers are no longer interested in going short and or buyers overtook the buying or the selling of short sellers. That's not how the markets work, folks. And ain't going to do it either. But now watch what happens. When we trade outside the band of this range, notice we're probing below it here, but it's only going 1 standard deviation of this inefficiency with that low right there. Remember, go back to it and look, see? Look at it. It's controlled. It's only allowing 1 standard deviation outside of this when it went lower. I'm not interested in seeing it go below that low because I don't think it's going to do it. Why? Why was I interested in only getting out when it went down here? Why was I doing that? Because this inefficiency told me that this 1 standard deviation down here is about as far as it'll go once it trades to my target 3. Okay? So once we get back inside of this inefficiency that's in purple, then I can start looking at the quadrants, the consequent encroachment, and the high and the low, the actual inefficiency. So you can see the low of the inefficiency here. Again, that's this candlestick's high. It's supporting it here, rallies up to upper quadrant, trades back down. It trades just outside of it here, but then goes right back into the middle and starts consolidating around the consequent encroachment or the midpoint of that purple area. Then the market trades one more time lower, and now it's allowing price to go outside the range of this inefficiency because it's it's enticing. It's luring traders to go short, and it's probing for liquidity below this low, and anything that's around here, they'll probe at and try to see if they can get that. But they got a short-term low here. They worked below that, and then rally back up inside of that purple shaded area, which is the first displacement in the midnight opening range. The market rallies back up, trades to the high of the opening range at midnight here, then back down to consequent encroachment. Consequent encroachment, that's the red level, which is essentially just half of the purple shaded area, which is this inefficiency. So we get to the low of that inefficiency again here. What time of day is that? It's 2:41. That's London open. We're looking at this rallying higher. We took this period of short-term highs here. That buy side was taken here. And then where's it go? Right back down into that first displacement in the opening range at midnight. Creates a short-term low. It trades below it again and goes right to the lower quadrant. Look at that. You can't get any plainer than precision. Look at that. Look at the low. Okay, look up here. Look at this value right here. Okay, keep your eye on that. Right there. Okay, see that low right there? What's that low? 21,705.50. All right. What's the value of the lower quadrant? 21,705.50. So the market does what? What is it going to do here? What's it going to do? It delivers on 3:30 macro in London session at 3:30. That's your sweet spot. And so at 3:30, the market starts to run away from lower quadrant of the first displacement in the midnight opening range. The market rallies aggressively up to some random projected level, negative 0.5, and then creates a retracement, makes a higher high, fails to take out the high, and then we trade back down into the first displacement again, stops dead end at the high at 5 o'clock. Now London session is done. Okay, what's going to take place now? We focus on the day session. Now what we'll do is we'll scrub over to and jump right into the 9:30 session here. And notice how we traded up in the electronic trading hours right ahead of the New York opening bell at 9:30. See how the price trades up here? Look at this. That's that -1 standard deviation on the midnight opening range. See how that delivered that? And then you have this nice turtle soup rally up and then breaks down. You see that? See that right there? Now, inside of this area here, okay, I want to refer back to a reference point that's found in regular trading hours. So right here, that's the opening price here and the difference between where we settled the previous day at regular trading hours. See that? Boom, boom. Those two reference points there. So now watch. If I highlight that volume imbalance, because that's what this is, and I'm going to highlight that. Now, because I have this here, I can go back to electronic trading hours. Having this regular trading hours reference point, volume imbalance, and extending it forward, and we're going into the 9:30 opening here. The market takes a dive, trades. Look where the bodies are. You see that? That's that midnight opening range. See how it did that? See how it's respecting that? And the market does what? It rallies right back up into that same area. And then look where the bodies stop. In my volume imbalance, I say, you can go no further. You stop right here. And the market breaks down once more. And it does something that I've taught in 2024, in the summer of 2022, inversion fair value gaps. Well, let's add that real quick. So the market's doing this. It's going from here. And see, look at that volume imbalance. You see the difference between this candlestick's close and this candlestick's open. That green candle here, there's a small little portion of price action right in there. I don't need that over here. And if we look at that volume imbalance right there, we have to use that when we're referencing buy side and sell side imbalances. So this inefficiency on the upside, normally we would expect it to trade back down because anyone that's watched my work, they'll say, oh, it's one of those fair value gaps. It's simple. You just go in and you buy that. Wrong. Wrong, wrong, wrong. The idea is we've already made a run and created the high, and then it bumped it here at 9:30. The high today is getting rated. Then it trades lower. Everybody wants to dogpile on it and go short. And then they send it right back up to that imbalance, that volume imbalance. And then we have this move lower. And this is an inversion fair value gap. So once we trade through it, coming right back up into the bottom of it. Look at the bodies. Is the bodies respecting the halfway point? Yes. You want proof? Let's do it. Here's the midline. Look at the bodies. Stopping dead in its tracks. Boom. Lower she goes. But in here, once we traded down into consequent encroachment of the midnight opening range, it's the 30-minute interval between midnight and 12:30 Eastern time. We went to consequent encroachment, traded back up to the high. Look what price it's touching. What's this dashed line? Remember that? That's midnight opening price, hour 3. So we can say that right here, that's the high of the day, this candlestick. The open is here. And one more time, they pass back up into a premium. We break lower, inversion fair value gap. Michael gets short, rides all the way down, slices through the midnight opening range. And look what it does. It leaves it aggressively. It's no longer interested in coming back to test it as a resistance or premium array. That's what? It's indicating the market's extremely heavy.